that. And where should we just start with the first one and work through, or should we do something different than that? Don't care. If there are problems that we don't need to bother with, we'll not bother with them. How about that? Good. So you want to rework these?
Yeah.
Quiz 527. Do you have it with you?
Oh, 527.
Yeah, 527. 527. Okay. All right. Anyway, so all right. So let's just go through and let's try all these different inventory methods and sort of rehash that. Anyway, what I'd suggest to you is number one on quiz 527. Okay. I suggest to you that you get yourself organized. Basically, you can use T accounts or you can use a little table. Doesn't make any difference. But keep track of both the units of inventory and the dollars of inventory, right? I do both of them. I track everything that's going on with them, okay? However you want to set that up. So the beginning inventory is 6 units at $5, right? Okay? So that's going to be what for beginning inventory? 6 times 5, obviously, right? So $30, I guess? Are you okay so far? Okay, so that's what we've got. Okay, that's where we started. Okay, and then and keep them in order, because when we do perpetual, you have to have an order, right? When we do periodic, it doesn't matter, because you pretend you bought everything before you sold it. Okay, so the first thing that happens is purchase 1. I just call it purchase 1, but that's the first date, January 1st. 11 units is $6, right? So this is 11 at $6. Okay, that's what those are. That's $66, I guess. So purchase 1 is $66. That's good. So at this point, I'd say I have 17 units, 6 plus 11. They cost me $96. That's all. Okay. And then the next thing that happens in the sale, obviously there could be a number of purchases in a row, there could be a number of sales in a row. Usually you don't make very many purchases in a year for each inventory item. You have lots of sales, right? So you have far more sales than purchases. But this is just for demonstration. Okay, so then the first sale is the next thing that happens. Sale 1. And if I told you there was a price on that, that would be the sales price, right guys? I'm going to compute the cost. So sale 1 is 13 units, is it? Okay, so I take 13 out, and I don't know what those cost. That's the whole idea here. I am going to calculate what they cost. So I'm using perpetual lock to make a journal entry for it. Debit cost of goods sold and credit inventory. Okay? If I do it periodic, I just wait to the end to compute the cost of goods sold. Okay, good. So that's sale 1. And then the next thing that happens is purchase 2. And purchase 2 is what, 15 units? And they cost me $7. Okay? So what's 15 times 7? 105. 70 and 35, right? So that's 105. Okay, so I got that coming in. And then the last thing that happens is sale 2. And I don't know what that costs either, except I do know how many units it was. Sale 2 is 11 units, right? So, you know, I do know the ending inventory in units. I don't know the ending inventory in dollars. I'm going to calculate that. Okay? To calculate my cost of goods sold, I'm going to calculate my ending inventory. Okay? So what is my ending inventory anyway? If you started with 6 and you bought 11 plus 15 is 26, that made it 32, right? And then you could take 24 away from that. How many are left with the 12, I guess? Did I do it right? 36, 17, less 13 would be 14, plus 15 is 19, less 11 is 8. I can't have that. Is that 8? Does that sound better? 6 plus 26 is 32, less 24 is 8. Yeah, okay, it's 8. Everybody good? So what I want to do is value those 8 units and value these 24 units. That's it. Okay? It's going to be beginning inventory plus purchases. And you don't have to write this down if you don't want it, but if you want it, you can. Units, dollars, right, is available, less my ending inventory. is cost of goods sold. Okay? So, you know, if you have beginning inventory 6 units and it costs you $30, and then you purchase 11 plus 15 is 26 units, that's how I decided I had 32 available, I guess, right? And those cost me a total of 66 plus 105, 171, is that right? So available is 201. You don't have to write it in a chart like that. It's right in the T accounts, isn't it? Numbers are there. Do it either way. Okay? And so now my ending inventory is 8 units because I sold 24. We know that. And what I want to figure out is this number and this number for all the different inventory methods. And you got it made, right? Just crank right through. Okay? So everybody's happy so far? This looks good? Okay. Let's see if it works this time. Whoa! Didn't want to do that. New page. And it still works. Good. Okay. So we're going to use that information. You got it in front of you, right? So we'll use that information and we'll do the different methods. Okay? So here we go. Let's do periodic first, because they're easy. Right? And I guess I kind of put them in a logical sequence here. I don't have to do that, right? You can read. Okay, so periodic. So periodic. Let's do FIFO first. What do we want? How many units do I want to value? Is it easier to do the ending inventory or to do the cost of goods sold? Seeing as you try to have as few units as possible on hand at the end, and you like to sell lots of them, which is going to be a smaller number, the ones sold or the ones you still have, quantity ones. Ones you still have, yeah. So it's going to be easier, right? The ending inventory is going to be easier. So let's calculate that first, huh? And then we'll back into the cost of goods sold. Does that make sense? Okay. So what would I say? How many units do I need? Ending inventory is how many units? Whoop. That's available. 8. 8 ending, right, guys? 8. 8 units. I would like to value 8 units for my ending inventory. And once I do that, I'm going to take those 8 units, whatever value they have, away from the 201, because the total available is 201, right, guys? Everybody see that there? Okay? And I'm going to add whatever the 8 ending is, take that away, and I know my cost of goods sold. I'm done. Okay? Easy? And so just relax when you do this. Which units? First in, first out. I sell my beginning inventory first, then my first purchase, then my second, then my third, and so on, right? Which are the last ones I'm going to sell? The last purchases I bought. So the last things I bought is what I'm still going to have left. Does that make sense? How many do I have left at the end? 8. What was my most recent purchase? 15 at 7. What do you bet it's 8 of those? First in, first out. So 8 times 7 dollars. Okay. And that answer was $56. Oh my gosh. It can't be that easy. Is that right? 8 times 7?
Yes.
Last in, first out. Or first in, first out.
Why wouldn't it be the beginning inventory considered first?
Oh, but remember, the inventory is not the first ones I bought. The cost of goods sold is the first one I bought. First in, first out. The ones that went out are the cost of goods sold. So what happened is this 6 I had at the beginning, see the 6 there that I had at the beginning? When I had my first sale, I sold 13, I sold all of those. That's the theory of it. And then I had to sell, I don't know, to get 13, another 7 of the next 11 I bought. You got the idea? And I continuously do that. So at the end, what would I have? I guess I'd have 8 of that last 15 I bought. Did that do it? It's real easy to switch FIFO and LIFO, isn't it? Because you start thinking FIFO must mean the ones I have left. No, first in, first out. Those are the ones I sold, the ones that are out. And now all of a sudden, oh, that makes sense. Got it? Okay? So, all right. So what would cost of goods sold be? Well, all you have to do is say, well, look, I've got, I made that nice and small, didn't I? I've got 56 in my ending inventory. So if you had 201 less 56, what don't you have anymore? Huh? These two always are going to have to add up to what, of course? The 201. Right? They've got it. Right? Because what's available is available. Okay, so there's periodic FIFO. Now let's try LIFO. Same thing. This time, though, I pretend I bought everything before I sold anything, which is absurd. But remember, you're not keeping track of perpetual inventory, so you don't know when you bought it and when you sold it. You just know how much you've got. Okay? All right, so what I have then is I started with 6, and then I bought 11 more, and I bought 15 more, right? Okay, those all came in. And then I pretend that I sold the last ones I bought first, last in, first out. So which ones would I have? This time I'd have my beginning inventory, right? So I need 8 units. Which 8 units? Well, I've got 6 from the beginning inventory, right? Everybody? 6 units at what? What I pay for the beginning? $5. There's $30. Okay? And then what? I need how many more? 2? Yeah. And you can imagine in real life this gets more complex mathematically, but it's the same thing. Right? You might have several purchases you're picking up. Yeah. So 2, and what would the second purchase, or the first purchase rather, second group I had was what? At $6? That's it. So that's $12. I'd add the 2 together, and what do I have? 42. And that's my ending inventory, right? $42. So what's my cost of goods sold? Yeah, and you do exactly the same thing. 201 less 42 is 159, was it? Looks good. You guys aren't going to miss these, are you? After you start getting good at it, you start thinking, gosh, how did I ever miss one of those things, right? Just too easy. Okay, let's try weighted average. What I mean by weighted is I buy all of them first. Remember to include the beginning inventory, okay? It's a common mistake. People leave out the beginning inventory, do their inventory at the average cost of what they bought. It's not that. It's all of them, huh? So I started with 6. It cost me 30. I bought 26 more that cost me 171. The total available is 32 that cost me 201, right? How would you find out what the weighted average is for that? Divide the $201 available, right? By the units available, which is how many? 32 units. Those 32 units cost me 201. What did the average one cost me? $6.28. The best thing to do is probably leave that in your calculator, right? Okay. Take the 628 times how many units for ending inventory? It's 8 units, right, guys? I got it made. So what's my ending inventory? 628 times 8. 30, 50, 25, something like that?
Yeah, use the exact.
Okay, cool. What do you want to do now? Well, 2 ways you could go. You can do exactly what we did with FIFO and LIFO. You can take away $50.25. That's very fabricating. 50.25 away from 201 is how much? 150.75. So I think the answer is 150.75. What do you guys think? Cost of goods sold. Because of course the total has to be 201. What's another way you could get to it?
You could do 201 divided by 24.
No, don't do that. Once I know the 628.
You would multiply, yeah.
Yeah, take the 628 times how many? The 24. Take 628 times 24, and what do you get, everybody? $50.75. Just make sure when you're done, if you made a mistake like that, you catch yourself with this. Make sure when you're done that your ending inventory plus your cost of goods sold equal to available. You're there. Okay? We good? So those aren't too bad, are they? Now, a really nice thing about perpetual, we'll put perpetual over here. A really nice thing about perpetual is FIFO gives me exactly the same result as periodic would. That's because every time I sell something, I'm selling the old stuff and keeping the new. So I end up with the last ones I bought, right? Still in inventory, because I'm always selling the oldest one, huh? Okay? So it'll give me the same answer. So all you have to do is for FIFO, it's the same as periodic. So I'm calculating twice, it's a waste of time. Besides, it's a pain to do perpetual. Okay? So then let's try perpetual. Go here. We'll have LIFO. These are inventory, is what we're doing. All these are inventory, right? Inventory accounts. And moving average. That'll be different than weighted average because we know what we have when we're selling it, right? And the same thing with LIFO. We know what we have when we're selling it. We don't wait for the end and pretend we bought them all before we sold anything. All right. And here what we're doing, but these methods are ridiculous, aren't they? They're really for tax reasons. Right? But you have to use them for financial statement purposes, for tax purposes. So people use these methods. Okay? So with LIFO, I'm pretending I'm selling the new stuff before I sell the old stuff. Okay? Be a mess if you're a bakery, dairy, or something, or any business really. Beginning inventory is what? How many do we have, everybody? 6 at $5, right? So keep track of your units. 6 times $5. This thing is $30. Everybody good? There we are. Then what happens? There's a purchase in this case. If there was a sale, which ones would you sell? Those 6, right? You'd have to. I bet you couldn't sell more than 6. You only have 6. So I'll give you a problem like that. Ask me about it. No problem. Okay. So purchase 1 happens next. How many units was it? 11 units. How much did they cost? $6. And we have $66. And what I say is I have $96 worth of inventory, right? 30 plus 66. I have 17 units. It's 2 LIFO layers. One is the beginning inventory, 6 units at $5. The other one is 11 units at $6. Which ones am I going to sell first if I do a sell? Last in, first out. The last one's out. Okay. All right. So then I have a sale. I happen to have a sale next. It's 13 units, right? Everybody agree? So sale 1 is 13 units. Which units? Oh, I'm going to sell the most recent purchase first, right? So 11 units at $6, do those go first? Absolutely. That's $66, right? And how many more do I need? 2 more, so I have to go back and take some of those 6. Make sense? 2 units at $5 is $10. How much is that? $76. Debit what? Cost of goods sold. Credit what? Inventory. It's the inventory account here, right? Taking them out of inventory. Credit inventory. Debit cost of goods sold, credit inventory. What do I have left now? I sold all 11 at the last purchase. And I sold 2 of the 6 I started with. How many do I have left? 4 units at $5. We call that a LIFO layer. It's going to be $20, isn't it? Well, 96 here less 76 is 20. A miracle, right? Of course it's true. Okay, that's all we're doing. Then what happens in our order? Second purchase, right? Purchase 2. How many units was it? What did they cost? How much was that? Isn't it nice to have it already written over there? Right? You already have it on your paper, you just grab it. Right? You don't have to compute over and over. So now I have 2 LIFO layers, right? I have a total of 19 units, which cost me $125. I have one layer that's 4 units at $5, my oldest layer, and my newer layer is 15 units at $7. Which ones am I selling first? The last 15 I bought, right? What's the next sale? How many units is it? 11 units, okay? So sale 2, 11 units, okay, good. Which ones are they going to be? Well, this time it's pretty easy because they just bought 15 at 7, so it's 11 at $7, isn't it? How much is that? $77. Debit what? Cost of goods sold, and credit what? Inventory. And what do I have left now? 4 units at $5. I didn't dip into them, did I? But of those 15 I bought, I sold 11. How many do I have left? 4 units. It cost me how much? $7. That's $28. How many units is that in my ending inventory? Because I have no more sales or purchases, right? It's 8 units. Does that sound familiar? Of course, it's got to be 8 units, right? That's my ending inventory in units. How many dollars is it? $48. Whoops. $48. You guys agree with me? Just falls right out for you. Okay? Building analytical skills here, whether you guys like it or not, or believe it, you are. Get really good at this. Get to see my intermediate students doing stuff today. And I just quickly explain stuff because yeah, I got that. Move on. Of course, they just had a week to work, and guess what they did? It worked. Almost unanimous. They know how to do stuff. Funny how that works. Work pays off. So 48. So let's check this out though. What's our total cost of goods sold here? 76 and 77 is how much? 1, 5, 3. That's what we think our cost of goods sold is. Let's see if it works. Need a bigger eraser. I can just click on a bigger one. Okay. What do we got? 153 is our cost of goods sold. Take that away from the 201, and what does that give me? 48. It's a miracle. Oops, I put it backwards. That's what you just said. My ending inventory is 48. So what does that give me for cost of goods sold? 150. Or vice versa. 201 less 153 is 48. Everybody see it? This works good, doesn't it? Okay, so let's see if we can do it with moving averages. Exactly the same idea, except when you buy things, what happens? You have a new moving average. You bought it for a different cost, right? That's it. Okay, and then when you sell things, you sell it at the average. So what we're going to do here is we'll have beginning inventory. How many units? By the way, they wouldn't be the same units in real life because your ending inventory of 1 year is the beginning of the next, right? That makes sense? So this is $30 to start with. Then what's the first thing that happens? Purchase 1, right? How many units was it? 11, right? At $6 is how much? 66. So where am I at right now before I sell it? And if you had another purchase, you just added it before you did your average. Make sense? How many units do I have? 17 units. What did they cost me in total? 96, just 30 plus 66. What I do now is I calculate my average. What is that? What's 17 into 96? 565. Okay, that's $5.65. Make sense? This isn't too hard, is it? Not really. Okay? When I sell them now, what's the cost of goods sold going to be for each one? $5.65. Okay? Leave it in your calculator with all the decimals. It'll work out better for you. You don't have to worry about rounding so much. How many units do I sell when I do sell one? Because it happens to sell next. Oh, is it 13 units? It's hanging in there. 13 units, what did they cost me, of course? $565. How much is that? $73.41. I hereby decree that's only $73. Okay? All right? You don't do that in real life, of course. The computer doesn't care about things. So what will be left? 4 units at approximately 565, of course. Make sense? Which equals what? 96 less 73? Don't you suppose? That's going to be right around $23. It is, isn't it? Okay? Actually, it's $22.60 or whatever. Yeah. Okay. All right? We got it? The next thing that happened to happen is purchase 2. How many units was it? What'd they cost? We're up to 7 now. Okay? I have inflation every time. We could have deflation. The prices could go up and down. Obviously. What's that? 105 we said? So what's available? How many units? 4 plus 15 is 19 units. I'm going to figure out what they cost me. What's the total amount I paid for them? 23 and 105, right? 128? Is that right? 128 divided by 19, what do you get? 670? 674 or something? Okay, $6.74 approximately. Now I do a sale, don't I? So they're going to be at that moving average, right? How much is that going to be? What do we got? How many units do we sell? 11 units that time. What they cost me? $674. How much is that? If you left it in your calculator, get a more accurate number. How much was that? So let's round it to $74. Close enough? Okay. By the way, both of these are debit what? Credit what? It's credit inventory, obviously. I'm taking it out of inventory. Moving average method of inventory, right? Perpetual moving average. Credit inventory and debit what? Cost of goods sold. That's my cost of goods sold, isn't it? Okay. So what am I going to have for ending inventory? Let's see, I had 19. I sold 11. It's a miracle. 8 units. They're going to be at what? 674. And how much is that going to be? 128 less 74 is 54. That's about what it is, isn't it? 8 units at, 8 units at $54, huh? Okay. What's my total cost of goods sold? 73 plus 74 is 147. All right. That's my cost of goods sold. So let's see if it worked again. Of course. What do we have for ending inventory? 54 this time? What's 201 less 54? 147, of course. Okay? You can do these, can't you? You know, what did I give you on the quiz for? 9 points? Jeez. This is a 30, so 3 times that much maybe? Wow, maybe 18, 20. They didn't do it well. Okay, probably huge. It's getting too easy. Okay. Let's do something else. Whoops. Trouble with it. Always. Get rid of that. That's big writing now. Okay, let's try the second one. Assumed liabilities are 40,000, stockholders' equity is 75,000, all assets other than current assets total 50,000 over the amount of current assets. Do you guys know assets equal liabilities plus equity? That's just okay, balance sheet. Assume the total liabilities are 40,000. Stockholders' equity is 75. Can you guys tell me what total assets are? 115. Yeah, I kind of agree with that. 40 and 75. And then they say, other than current assets, all assets other than current assets are total 50. So this is total. What do you bet the current assets plus the non-current assets add up to the total 115? You guys agree with that? Okay. So if all of them except for the current assets are 50, what do you think the current assets are? It's like 65 to me. That's the answer. That's annoying if you didn't get it right. Okay, relax. But you know, if earnings per share is 250 and the number of shares of capital stock outstanding is 6,000, what's net income? Well, how do they get earnings per share? Net income divided by number of outstanding shares equals earnings per share, doesn't it? Isn't that true? So I know the earnings per share is 250. I know the number of shares is 6,000. What do you want to do? I'm going to take 250 times 6,000 and find out that you got 15,000 net income. You don't have to remember any formula or anything. It's just kind of common sense, isn't it? If every share earned 250 and there's 6,000 shares, well, I guess they all earned 15,000. Just multiply it together. Okay? I'll fall out here. Yeah, it's so exciting today. Must be the sun's gone, right? It's 75 degrees with rain. It's ridiculous. I'm ready for summer until it gets hot. Then we'll be miserable because it's too hot. Number 3. Okay, this is that allowance for doubtful accounts thing. Are these getting easy? What students seem to do is they'll either use one method or the other, but not be able to do both of them. I don't understand, so they get half the points. You know, they're different, right? If I give you an estimate of bad debts based on sales, what are we estimating? What goes on the balance sheet with sales? Which account? What goes in the income statement with sales? Bad debt expense. If I give you an estimate based on accounts receivable of what's not going to be collected, right, bad debts, what account must we be estimating? What goes in the balance sheet with accounts receivable? You know, that's the trick. That's all there is to it. The trick. What it is, right? Okay, so here we go. They have accounts receivable. Key accounts might help you here. Might be helpful. Accounts receivable is 25,000. That's an accounts receivable. The allowance has a 200 credit. That's going to go on the balance sheet. This is the portion, allowance for doubtful accounts. This is the portion of the accounts receivable we think we're never going to collect. That's what goes in that account. 200 is not very much, but we're going to increase it. That's what we're doing, right? To what we think it should be at the end of the year. How does it get reduced? People write off accounts, don't they? Okay, when they write off an account, it goes down. Okay? So we got 200 there. And then over on the income statement, I've got sales. It says the sales are 400,000, all credit, which means all on account. Okay? And then what account is going to represent the sales we're never going to collect? Bad debt expense. The allowance represents the receivable they're never going to collect, right? Bad debt expense represents the sales they're never going to collect. What would be the balance of that account seeing as they didn't give it to you? You'd assume nothing. You haven't put it in yet. Okay, so in A, when aging is completed, they estimate that 2,150, the receivables outstanding at year end, will not be collectible. What account would I like to be 2,150? I'm basing it on the receivables outstanding. I'm saying 2,150 of that 25,000 are never going to be collected. Does that make sense? So what account do you want to be 2,150? The allowance. Now you don't put 2,150 in the allowance to make it be 2,150 if 200 is already in there. How much do you need to put in? 1,950. And a whole bunch of people put 2,150 in there. Don't do it. Or they put in 2,350, which would make it 2,550. Not going to work, right? So I'm going to credit allowance for doubtful accounts for A. Credit the allowance for doubtful accounts. Just to make it be what I want it to be, 1,950. And that forces me to debit what, everybody? Guys are so quiet today. Bad debt expense, right? Got to be. Okay? Are we good on that one? All right, let's try B. It is estimated that 1% of credit sales will prove uncollectible. Well, now we're saying we have exactly the same situation, but I don't care what the allowance is right now, right? It doesn't matter, because I'm not basing it on accounts receivable. The accounts receivable are still 25,000. The allowance for doubtful accounts is still 200. The sales, all credit, are still 400,000. Bad debt expense is still nothing. Okay? And it says 1% of the credit sales are never going to be collected. What's 1% of the credit sales? What's that $4,000? Bad debt expense, right? It's the portion of sales you're never going to get. I want this account to be 4,000. What am I going to have to do? Debit it for 4,000. Debit bad debt expense. And credit. Yeah, you're forced to credit the allowance. What if I asked you what the balance is now in the allowance? Would that bother you? Who cares? 4,200 would be your answer, wouldn't it? What if I asked for net realizable accounts receivable on this one? It'd be 25,000 less 4,200. That's the portion you expect to collect, right? What if I asked for it on the one before, on A? 25,000 less 2,150, right? Your net realizable receivable. Good? Okay. So there's A and B. Okay? So you got them both. Right? Let's try. Do another one. Okay? What was C? It says assume the same information except prior to adjustment the allowance has a debit balance of 200. So I've got accounts receivable. All the way, I guess it is. So I've got accounts receivable. 25,000, right? Okay. I have an allowance this time with a debit balance. How much is the debit balance? It's 200, isn't it? How'd that happen? They wrote off more than they had in the account at the beginning, right? Because every time you write off, you debit the allowance and you credit accounts receivable. Okay? So I got a 200 debit in there. Okay? Sales, still 400,000, I guess. Bad debt expense, still nothing. True? What do I want to do? Figure out what bad debt expense should be and what the allowance should be. What does it say? Same as A. Oh, A says 2,150 is what I want the allowance to be, right? I'd like this to be 2,150. Right now it's 2,000. What are you going to have to do to get there? Credit it for how much? 2,350, right? Because 200 will make it 0, and you'll have to add another 2,150, so 2,350, just like that. And when are you going to be forced to debit? Bad debt expense. So if I asked you for bad debt expense, you'd say 2,350, right? If I asked you the balance in the allowance, you'd say 2,150. If I asked you for the journal entry, you'd write the journal entry. You don't care, right? If I asked you for net realizable receivable, it's 25,000 less 2,150. Huh? Okay? So it's going to be debit, bad debt expense, credit allowance for doubtful accounts, for 2,350, is it? Okay, we are done. Okay? That's C. So what did D look like? Assume everything's the same, except we have that 200 debit instead of a credit of 200. But you know what? In that one, it's just 1% of sales. What's the journal entry going to be? Same thing. It's going to be the same as this one was, isn't it? Debit bad debt expense. It's 1% of sales. I wouldn't even write down the key accounts in this one. Well, what if I asked you what the ending balances were going to be in the accounts? I'll write the accounts down and put the journal entry in. right? Should be pretty simple. Accounts receivable is how much? 25. Allowance, it's a debit of 200, was it? Sales at 400. Bad debt expense was nothing. Start with. Got anything yet? I make my journal entry. My bad debt expense is now how much? 4,000. True. And what would my allowance be? This time, 3,800, wouldn't it? Right? And what would my net realizable receivable be? The difference between the two. Easy all of a sudden. True. Oh. Let's try number 4. Number 4 says the balance sheet for Glenwood has showed the following current assets, current liabilities. Okay. Property, plant, equipment, equity, retained earnings, retained earnings plus accrued capital is equity. Total liabilities, fine. Other long-term assets, they got a variety of kinds of assets. 3 of them looks like. Total assets, what would you do for total assets? What's current assets? 140. What's property, plant, and equipment? Current or a non-current asset, right? 140 and 420 is 560 so far. And then there's other long-term assets of 70. What's that going to be? 630. Did it, didn't it? So I got 630 in total assets. You know that assets equal liabilities plus equity? That's too easy. 630,000. Okay? All right, and then the second one says, what's long-term liabilities? Oh, I don't know. If I knew equity, I could get total liabilities, though, couldn't I? And I know what the current liabilities are. So let's see if we can get total. Well, we know total equity, right? What was total equity? 420. What's total liabilities? 630 less 420 is 210. You guys agree with that? So if that's total liabilities, I bet that's the current liabilities plus the non-current liabilities is total liabilities. Pretty bad. Total liabilities is 210. Do you know the current liabilities? It's 80. What's the difference? 130. It's the answer to the question. 130. Got it? Then what's contributed capital? Well, what does equity consist of? Contributed capital plus retained earnings, right, guys? So total equity is how much? 420. I'm just writing down what I know and stopping what I don't, aren't I? What's retained earnings? What must be contributed capital? And then total liabilities and equity is really nice after you have total assets because it's what? The same number. So it's 630. Okay, 630 and 630. Piece of cake, isn't it? Okay. All right. So then we're going to try to do bank reconciliation, I guess. And number 5. And journal entries related to it. Okay, so what we're going to do is we're going to figure out how much is on the bank's books per bank, and we're going to figure out how much is on our books per books on our general ledger. Now in this problem, a couple people made this much harder than it was. I gave you the numbers this time. I think the practice quiz, you had to calculate it or something. But the ending balance on the bank statement says what? 11,045. Can you agree with that one? The ending balance in our books is 10,800. We're going to keep working until we reconcile between those two numbers. Find out what the real cash is. Make a journal entry on our books to get to the real cash. So what kind of things do you know about it here? It gave me a deposit in transit and outstanding checks. It did it for me. I'm doing June's bank reconciliation, so of course I want the ones at the end of June. I don't have to worry about May's. I don't have to worry about what cleared and when. This was a more straightforward problem than the one on the last quiz once we've done the class. Okay, so deposit transit at the end of June would do what? The bank doesn't know about it? Stuck I had. I do. I recorded it in my books. The bank has not recorded it yet because they didn't know it existed. Right? That's 400.
So those checks that, like, the bank that the company wrote, that they didn't get to
The bank doesn't know about those either. Those are the outstanding checks this month. Last month's got there.
So outstanding is the ones that we wrote.
Yes. deposit and transfer is the deposit we're sending. Outstanding checks are ones we wrote that have not gotten there yet. They're outstanding. They're out there somewhere. Okay? So I'm going to deduct the outstanding checks. Make sense? How much is that? There, 525. I wrote them. I took them out of my checking account, right, on my books, right, my general ledger, my cash account. But the bank doesn't know about it yet. That's all. They're not wrong, right? They just don't know yet. They're going to get there. So how much does the bank think that we have in our account? We call this an adjusted balance. What's the balance that we really have according to the bank? 11,045 plus 400 is going to get there later. Less 525 is going to get there later. Is that 10,920? Okay, just like that. Okay, then what do? You say, well, what does the bank know about that we don't know about? Okay, what kind of things? I go down through, does the bank know, do we know about the deposits? Yes. Do we know about the interest? No. So interest paid by the bank. That's going to be interest added to my account. Interest revenue added to my account. I earned it, right? I have 240 more than I knew I did. I'm going to debit cash for that, credit interest revenue, aren't you? I earned it. Okay? I'll wait you one journal for the whole thing. And that's what that one's going to be. Checks cashed. I knew I wrote the checks. I've taken them out, right? Same with the deposits. I knew I deposited them. I put them in. Bank service charge? I don't know about that yet. Service charge, expense, miscellaneous expense, right? Bank service charge expense. Yeah. I didn't take it out yet. The bank did. So I'm taking it out. Okay? NSF check, what's that? I deposited a check in my deposits from a customer, and then it bounced. The bank put it in my account. They've taken it back out, though. I haven't taken it out yet, so what do I need to do? Take it out, of course. And what's it going to be now to me? Either a bad debt, which would be debit allowance for doubtful accounts, writing it off, or an account receivable. Probably I put it back in accounts receivable to try to collect it. Huh? Okay? Most likely. And now at this point, I pray I get exactly the same number for an adjusted balance. If I don't, I start looking for errors. So you get the same number? You know, this probably did, which is really nice. If I didn't, I'd go investigate. I'd look at all the checks that I wrote, compared to the checks that cleared the bank, make sure they're the same amount, all the deposits I made compared to what went through the bank, get deposits to the bank, make sure they're the same, that kind of thing. Okay, anyway, once I have those numbers right, all I need to do is do my journal entry. So that was part A. What do? I'm not doing the bank's accounting. Besides, they're not wrong anyway. I'm not going to call them up and tell them they're wrong. So just wait until they get the deposits and they get the checks through. So what I'm going to do is make a journal entry for this. What do you want to do to cash? It is 10,800 on the books. I wish it was 10,920. How about debiting it for 120? When you do that, what do I want to do with interest revenue? I earned it. It's revenue. Credit interest revenue for how much? 240, huh? What do I want to do with expenses? Debit them, of course. Service charge expense. They're 20. Just going down the list here. That one, that one. What's the 100? Oh, I have an account receivable. Debit accounts receivable, 100. Does my journal entry balance? I have to make sure it does. Does it? Yes. Okay. Just like that. Easy, huh? Great. And the last month, we did pretty good, you guys. Number 6. Dallas Company prepared income statements to reflect pre-tax income of 21 for 2009, 30 for 2010. An audit has determined there were 2 errors in the inventory amounts as follows. Ending inventory at the end of the first year, 2009, reported 15, should have been 14. So it looks like what? It was overstated by what? You guys agree with that? And at the end of the next year, it reported 18, should have been 16. It's overstated by 2. Okay? So here's what happens. Let's think about it. guys do know that inventory is one of the assets, right? Okay, so that's one thing that would be wrong. Okay. And then we've got revenues less expenses, net income. And you know that cost of goods sold is affected by inventory, right? So our net incomes would be messed up, and we have 2009 and 2010. And then in the expenses is cost of goods sold, right? Cost of goods sold for 2009 and 2010 are going to be what? Beginning inventory plus your purchases is what is available, true? Less your ending inventory is cost of goods sold, which is where that cost of goods sold comes from. So all of a sudden this looks really difficult, but it's not really too bad. You just keep it straight. What happened the first year? The ending inventory is 1,000 overstated, right? So what we could say is, look, in 2009, the ending inventory is too high by 1,000. That's the mistake they made, right? It's too high, it is overstated. You guys agree? Too high, overstated. Okay? There's no reason to believe anything was wrong with the beginning inventory. There's no reason to believe there's anything wrong with the purchases because they didn't say anything about it. So available is probably just fine, but we made the ending inventory too high by $1,000, didn't we? What did that do to cost of goods sold? Subtracted 1,000 too much from cost of goods sold. Made it too low by 1,000. You guys agree with that? That's what happened. Which means that my expenses are what? Too low by $1,000. Okay? If my revenues are fine, it didn't say anything about revenues, and my expenses are too low by 1,000, what's wrong with my net income? Too high by $1,000, which is why the equity is too high by $1,000. Is anything wrong with liabilities? No. So nothing plus 1,000 equals 1,000, no kidding. Okay? That's all that's happening. Now remember though, the end of one year affects the beginning of the next, of course, right? The impact at the end of the year has the same impact at the beginning of the next. So in equity, I have too much equity by 1,000 in the first year. That's in 2009. In 2010, that arrow gets fixed. So let's say there were no error the next year. There is one, but let's say there wasn't one. What would be wrong with our beginning inventory? This is the trick. Remembering this. What's wrong with my beginning inventory? If the ending inventory is too high by 1,000, what's wrong with the beginning a millisecond later? It's too high by the same 1,000. If purchases are okay, what does that do to available? It's too high by 1,000. If ending inventory is okay, what's wrong with cost of goods sold? It's too high by 1,000. Can you see that error correcting itself? So what would you say? Expenses would be too high by 1,000. If nothing's wrong with revenues, net income would be too low by 1,000, and the error would correct itself. They always do. Okay? Which does what when I close that net income to equity? It's too low by 1,000, but what's wrong with equity at that point then? Nothing. Got it? Nothing's wrong. Everybody agree? You know, you're overstated in 2009 and 2010, you corrected. Nothing's wrong. Okay, but that's not what happened. We got more. So let's do that. What changes here? Yeah. So it's too high. So I'm subtracting too big a number. Like how much? 2,000? 18 and 16. Yeah. It's too high by 2,000. So what does that do? If you subtract too big a number, it gives you too little cost of goods sold, but that's going to be offset by the too much cost of goods sold. So what do you have? Too much by how much? Whoops, too little by how much? Too little again. 1,000, right? So that error is going to flow through into next year, huh? So what I've got is a 1,000 overstatement of cost of goods sold and a 2,000 understatement of cost of goods sold adds up to a net 1,000 understatement, right? We add the two together. So cost of goods sold is too low. Expenses are too low by 1,000 in total, which makes net income too much by 1,000, right? So it's too much by 1,000 again, which gives me what when I add the 2 years together? Equity's too high by 2,000, which is because inventory is what? Too high by 2,000, wasn't it? Comparing 16 to 18. Yeah, it worked perfect, didn't it? Drive you crazy, but it worked perfect. Okay? So what are my answers? Let's see. In 2009, they reported 21,000 income, and that's too high by 1,000. So if they reported 21, and that's too high by 1, what's the correct? 20,000. That's your answer. Okay? A lot of work to get there, isn't it? Okay? 2010 reported was how much? It's 1,000 too high. What's correct? Can you guys do these with a little practice? Yes, absolutely.
For the 2,000 in equity, did you get that from the equity cheat chart you made?
Yes, I had the beginning was at 1,000 too high, right? 2009. I'm sorry, the first year, 2009 was 1,000 too high. 2010, that's 10. Sorry. 2010 it's 1,000 too high again. So you add the two together, it's 2,000 at the end of 2010.
Okay.
Got it. Net income's too high both years. Got them together. Because then you get close to equity, right? The arrows stay in equity until you fix it. Okay. Good. Good, good, good. Easy? No. Those aren't easy. They're doable. Okay, good. Enough on 5 through 7? Study stuff that's not on these quizzes, of course, right? So that's a homework. Test looks like it's a lot of fun. It's kind of long, but all my tests are long. All right, and we'll do the quiz from today. Let me go grab the fixed water. Is the water safe in this building again?
Yes, it was never safe. Oh, the boiling advisor.
It is.
I guess they never said it was lifted, but I guess it's fine
I've been
now.
drinking it.
Yeah.
I've been
I think I'm
drinking
okay
it.
right now.
Maybe I won't drink it. I'll lift about it. Yeah. I'll wait until they say. Besides, even if it's safe, it probably hasn't run through the system anyway.
So we're going over test quick.
Yeah, let's do today's quiz. You guys can help me with this one. Come on, I get to have the answer. Let's see. The trick on the first one here on quiz chapter 8 through 8 and 9. Martin Corporation sold a piece of equipment for $45,000. They bought it January 1st for $240. Everything was fine. Estimated useful life 5 years, $20,000 residual. What's my depreciable value? $220. Right, guys? Not a big deal. Okay, they've been using straight line. That's nice. I like it. So it's going to be 220 divided by 5 years to find out what the depreciation is every year. What was that? 44,000. What you came up with. But then the kicker is, oh, they sold it. When? June 30th. And even underline that. What's that? Mid-year. So what are you going to have to do? Depreciate it up to the point when you sold it. First, you need to depreciate it up to the time when you sold it. It's for half a year. So what's been going on every year is what? They debited depreciation expense for $44,000, right? You don't have to write this down, but they did. They credited accumulated depreciation for $44,000 every year. You guys know where the 44 came from, right? 240 less 20 salvage value is 220 divided by 5 is 44,000 every year, right? So they did this how many times? 3 years have gone by, right? And then there's another half year before they sold it. So what you have is you have equipment on the books, which you would have debited equipment, credited cash, or whatever you paid for it, and that would have been 240. Am I right? You have 240,000 in this account, and then you'd have accumulated depreciation where you would have put what? 44,000, but you'd have done it 3 times, wouldn't you? So what's in that account? What's 44 times 3? 132? Yeah, but I need 6 months more. So this you didn't have to do, right? But first you would have to do what at June 30th when you sold it? Debit depreciation expense and credit accumulated depreciation, right? How much? Half a year, 22,000. So I wanted to see that. Now I've got another 22,000 in here, don't I? So how much is in there now? 154 it looks like. And now I sell that asset. Okay? My gain or loss just changed by 22,000. Loss went down or gain went. Loss. Loss went up. Gain went down. Yeah. Okay. So what would we do? Also June 30th, how much cash did we get? And most of you got this, which is really good. I mean, you know, get everything you can. 45. We got rid of the piece of equipment, right? It cost 240, did it? Excellent. Okay. How much accumulated depreciation do we have on it now? 154. So all I did was I got rid of that asset, didn't I? Right? And then what do I have? Gain or loss, I guess. It was, how much was his book value? 86,000. Sold it for 45. I think you lost, somebody say 41,000, is that right? Lost from there. It's not a big deal. Could I combine those 2 journal entries into one? Sure. What would change? I'd have the depreciation expense, I'd have the cash, I'd have my loss, I'd have the equipment, and I'd combine those 2 into one entry of 132.
You did both of those journal entries?
Yes. Yeah. So if you left this one off, I think I took away a point. Yeah. Okay. So good. Makes sense though, doesn't it? And so be careful. Be thinking. Let yourself think. Okay. Don't try to. I always say that. Don't try to remember. Let yourself think. Oh yeah, I do. Anybody else? You were all here already. Oh, there they are over there. All right. So let's try the second one. And this was kind of shortcutted, wasn't it? On a test, maybe I'd have you do more of them, but you had to be able to calculate anyway to do them. So I said the company acquires a machine for 18,000, estimated residuals 2. How much are you going to depreciate? 18, right? It's your depreciable value. So for the 3 methods, you'll have a straight line. Okay, this is 4 years, and how long am I depreciating this for? 2014, 15, and 16, I guess. It's the 3rd year, isn't it? So what would straight line be? I have a cost of 20,000. Depreciable value or salvage value 2. Whoops. Salvage value or residual value. My key. Salvage value or residual value 2. What's my depreciable value? 18. Straight line? 4 years, is it? Divide 4 into 18, what do I get? 4,500. Every year I'm going to debit depreciation expense, credit accumulated depreciation for 4,500. So for the first answer, what's my depreciation expense? 4,500. I've done it for how many years? 3. Take it times 3. Okay, so how much is that? 13,500. There's your first 2 answers. True? Okay, what's my remaining book value if I ask for that? 20 less 13,500, right? 6,500. When I depreciate 4,500 more than actually it would be 2,000 left for remaining book value. True? There's straight line. Units of production. What am I going to do? I get 10,000 units. What am I depreciating? How much? 18,000, right? So the depreciable value is 18,000 divided by 10,000 units is how much per unit? $1.80. Every time I produce a unit, I guess, right, for this machine, I am going to have $1.80 of depreciation. Okay, in 2016, we can do that one first if you want. What would it be for 2016? It's 2,400 units, right? At $1.80. They're all $1.80 based on my estimate. And that was how much? 2,880. Debit depreciation expense, credit accumulated depreciation, right, guys? Would you agree? Is that right?
I got 432.
You got what?
432.
2,000. What did I do? 2,400 at $1.80 is not 2,880, is it?
That's 432.
432. Oh, I have 432 over here. I read the last line. It's 432. I apologize. That's the answer for $265. Thank you very much. 432. That's okay. Debit depreciation expense, credit accumulated depreciation. And then what you could do is you could add up the 3 years that they've done. 2,000 plus 2,200 plus 2,400. How many units is that? 6,600 for all 3 years? You guys agree with that? Times $1.80, how much is that? That's how much they'd have at the end of the 3 years. How much is it? Yeah, that's it. Just like that. Okay? Or what you could do is just do the other 2 years. 15 and 14 is 4,400 times $1.80, and that's the difference between those two, right? And then add it to the 4320. Everybody stay with me on this? Not a big deal. Is the 11,880 right? This is the total units they've used. Okay. Okay, and then I didn't give you some of the years digits today. What do you bet I do on a test or a final? Just for fun. 200% declining balance. What do you want to do with this one? This time I'm going to depreciate based on my cost, right, you guys? And you're going to have to show each one of the years. You don't have a choice because you're always taking a percent of the declining balance. Okay, so my book value at the beginning is how much? At time 0. So we've got time 0, 1, 2, 3, and we'll go ahead and finish it if you want. Time 4. You don't have to because we only want the 3rd year. But I'll have my depreciation expense, right? And my accumulated depreciation. And my book value is the difference between the 20,000 I start with. So at time 0, it's 20,000. Okay, it's the difference between the 20,000 accumulated depreciation if you go along. There's not at the beginning, of course. What would I do? Straight line would have been how much depreciation? 1/4 or...
You put 5.
Was it a 5-year life? Oh, I changed the life. Oh, way to go. All right. Made it harder. So 1/5, I missed it, I guess. 1/5 is 20%. And we want to double it. Make that part easy, please. 40%. 200% declining balance. So I'm going to take 40% of the 20,000 the first year. Am I right? How much is that for the first year? 8,000. Debit depreciation expense, credit accumulated depreciation, and what's my remaining book value? Of course, 20 less the 8 is 12,000. You guys good? Then it's 12,000 times 40%, right? How much is that? 4,800. Debit depreciation expense, credit accumulated depreciation. Now, how much do I have in accumulated depreciation? 12,800, right? Very good. Not too bad. And what's my book value? 20,000 less 12,800 is 7,200. What would I do the 3rd year? Take that times 40%. How much is that? That's the 2,880. That is the answer for 2016, right? This is 2016, right? Okay. What's my accumulated depreciation at that point? 12,800 plus 2,880 is 15,680. And what's the remaining book value? So that's the second answer. Okay, for that one. What's the remaining book value? 20,000 less 56880 is 4320. What if I ask for the next year? I want to take that times 40%. Can I? I don't want to go down to 2. I think I'm okay.
Yeah.
But if I want to go down to 2,000, it's got a 4-year life. You know what you really have to do? You really have to do the 2,320 back here. Or we would have had to switch it so we get up to 18,000 here. I would never do that to you. So we have 2,500. Or we would have switched to straight line when it was appropriate, right? So where that thing. Okay. Everybody good? And number 3. We didn't have to do 4 years. Which of the following situations will not cause a deferred income tax account to be recorded? Either a deferred income tax liability or a deferred income tax asset. Wow, I don't know. You look at this. This is tough. There's only one point, but an expense is recognized in 20A for tax purposes and in 20B. An expense that is recognized in 20A for income tax purposes and in 20B for financial statement purposes. Will that cause a deferred income tax amount to be recorded? Yes. Absolutely. Right? Different timing. They're in different years. An expense that is recognized in A but will never be deducted for income tax purposes. That's a permanent difference, not a timing difference. There's not going to be any deferred income tax because of that. That will not cause a deferred income tax amount. A revenue is recognized in A for income tax purposes and B for financial statement purposes. Guess what? Same thing, time difference. So what's the answer to that, you guys? Even though I marked it wrong on the quiz, it is B. Okay? Never going to be on the tax return. Okay? So that's a permanent difference. That was kind of tough. Okay, then we did some present value calculations. That's present value and future value calculations. I put the hard 2 first. I hope you didn't panic from that. And the rest of them were not too bad. The first 2, wow. He's trucking, huh? Is replacing part of their fleet by purchasing them with a note agreement with Kenworthy on January 1st, 2014. It will require $5 million in annual payments starting December 31st, 2014. Continuing for a total of 6 years. Final payment December 31st, 2019. Kenworthy will charge He's trucking the market rate of interest of 8% compounded annually. How is this thing going to work? What is this? Present value of an ordinary annuity, right? I'm not really giving them $30,000. I'll give them $30,000 in cash, but it's not worth that. I take the interest out. So I think I have an annuity payment, ordinary annuity payment. $5 million. But there are going to be 6 of them. So remember what you're valuing is $30 million. Now, take it right up front. The first class, I got rated, this problem rated. The first class got the answer to this. 2 people did. Out of 20 folks who showed up for that. Right? This isn't that hard, though. What made it hard? They didn't tell you what you were looking for. Well, I want to know what they're going to debit very quickly. What's that? What you pay, present value. Same thing for the liability, right? Present value. Okay, so I've got $5 million, and what do I want to calculate on it? What its present value is right now. Okay? That's it. So I'm going to go look up a factor for what? Present value, or use your calculator. Present value of an ordinary annuity. Interest rate, guys? 8%. Number of periods? 6, right? 6 payments. Do you think this value is going to be more or less than 30 million? I had people tell me it was more than 30 million. I had people tell me it was 5 million. What do you think about either of those answers? More than 30 or 5 or something. That's ridiculous, right? What's it got to be? I'm going to take interest out of the 30 million. Something less than 30, but I bet it's more than 5. What's the factor for N is 6 periods. I is 8% on the present value of an annuity table. The factor is going to be less than 6 because you're taking interest out, but not a whole lot less. What's the factor?
4.622.
What's worth $4.62? $1 received at the end of each period for 6 periods. $6 is worth $4.62. What would the difference be? The $1.38 out, right? $6 less $4.60. What would that be? That's the interest, right? The difference. So it's 5 million times 4.6229. Is that 23,114,500? You can do these, and this is really valuable. You can do it, you guys. Honest, you can. I believe you can. Faith. All right, and then it gets harder in a second. So that was 2.5. It's harder in a second. What is the remaining obligation on January 1st, 2015 after the first payment has been made? Two ways you can go on this. You could say, well, I owe them $23,114.5, and I'm giving a $5,000 payment, right? So I would do an entry, credit cash, for $5 million, not thousand, $5 million, right? I would debit notes payable, because this would be the credit in notes payable, right? So debit equipment, credit notes payable. You guys agree? So my note payable is $23,114.5. What's my interest rate? 8%. What's the interest for a year? Oh, that's not too bad. What's 23,114.5 times 8%? What is that? Put it right there.
1849.
160. Okay? So 1849160, 8% of that number. So I think the interest expense is 1849160. Make sense? So how much note payable got paid off? You gave $5 million and 1,849,160 was interest. 849,849. That doesn't work. Okay, 1,849,160.
And we just added 5 million to.
No, 5 million less that.
Oh,
I'm sorry. I gave him 5 million. How much did I reduce the debt by? The interest is 1,849. 5 million less 1,849,160. 3 million something?
3,150.
So now how much would I owe them? 23,114.5 less 3,150,840, right? How much is that? Like this, pay them. 23,114,500. And I just paid off 3,150,840.
199,636,660.
199.
636.
19963.
660.
That's it. Okay? There's a remaining balance. Now there's another way you could do it. What you could do is you could say, well, I don't have 6 payments left anymore, I have 5. You could take 5 times the present value factor at 8% for 5 periods, and you will get 19,963. So it's close, right? It's rounded. That's it. You guys do this? Not yet, but if you work at it, you will. So, you get these kinds of, these two right, that's sort of the difference between an A and an A minus, B plus, right? You're going to be able to pull these kind of things off. Okay? All right, so then let's do some that aren't so quite so horrendous. By the way, if you go to intermediate accounting, they'll all do that, right? Complex, more complex situation. Kate's grandmother promised to give her 5,000 into 4 years and 6,000 into 5. She can earn money at 5% interest, right? How much is that money worth today? Well, both of those are future values, and I'd like to know the present value of them and then add them together. What do you think? Sound good? So I have a future value. How many periods from now is it? First one's 4, which is $5,000. Interest rate is 5%. Number of periods obviously was 4. What's the present value of it? That's all you had to do was calculate the present value of that thing. Right? So you can go look up the factor, you can use your calculator, right? What do you get as the present value of that? Go ahead and calculate it. You could take 5,000 times the present value of sum, right? Or you could take 5%, 4 periods. Or you could take 5,000 times 1.05 raised to the 4th, right? So get that one. Make sure everybody gets the same thing. Use your calculator to do it, of course. What do you get?
I got 4114 when I rounded.
4114 approximately?
Yeah.
All right, good. But then we have another one, don't we? That's one of them. So what's the other one? Is the future value of how much? 6,000? 6 periods of 6,000, or 5 periods, I'm sorry, into 5 years. Excellent. Okay. I take 5%. N is 5 periods. Right? 5% and 5 periods. What's the present value of time 0? Do exactly the same thing. Use a table, use a calculator, I don't care. Use the formula. What number do you get for that one?
I got 4701.
Okay, so here's what the first payment's worth, here's what the second payment's worth. What do you think the whole thing's worth? Add them up. What do you get? 8, 8, 1, 5. Did you guys get that one when you did the quiz? Maybe? No?
I didn't know.
Didn't have.
I just got it mixed up.
Yeah, mixed up. You won't do that again, right? You got to practice these a little bit, guys. But you just do. And I don't mean you haven't already done. I know you haven't. And you just have to keep after it, keep after it. You will get so this is just automatic. You can do this instantly, and you're much more valuable. You just all. Okay. Everybody does this without thinking it's a big deal. Even it's terrible. All right, let's try 7. Laura deposits $10,000 in the bank today. What's that? I think it's the present value right now. What do you guys think? It's today. Today is the present. The interest is going to be 6% annually. By the way, what if I said it was semi-annually? You double the number of periods, you got the interest rate in half, right? Okay, so the 6% interest, and we said we're going to do it semi-annually, it'd be 3% interest, we double up the number of payments. What's N? 8, right? 8 years. Okay, and we want to know what it's going to grow to, don't we? Future value of periods from now, what you have at the end. Calculate that one. Same thing. You use the tables, only this would be a future value, the sum table, wouldn't it? Right? So if you can identify those, you can plug them in your calculator easy, can't you? So you put present value in as 10%, put interest rate in 6%, number of periods 8, ask it to solve for future value. What'd you get on that one?
I got 5 times 38.
So did I. Did you get that on the quiz? Oh. Yeah. Okay. It's not bad, is it, guys? That's the guys, and everybody here is a female. Should be saying gals. Something wrong with saying gals, I don't know why. Right, women? There we go. That's better. Can't say girls. Although in Kentucky, you can. But on the West Coast, you can. On the East Coast, you can. Because that's sexist, right? They're called young women girls. Right? Girls are in junior high or something. I don't know. Maybe cease to be girls. I call my granddaughter granddaughter's women, though. Just look. Okay. They're 5, though, so. For me, you guys are girls, trust me. All right. Anyway, number 8, is that where we're at? If the market rate is 7%, a rational person would just as soon receive 100,000 3 years from now as what amount today. What is that? It's its value now, which is its what? Present value? So I know what? The future value, how many periods from now?
I have a question.
3, yes.
It says a rational person would just as soon receive $100,000 3 years from now.
As how much now?
So we're finding present value?
Oh, yeah, yeah.
It's with,
If the market rate is 7%, rational would just as soon receive 100,000 3 years from now as what amount today? What amount today? What's today? The present.
like
Yes,
the
I'm-
100,000 is future, is the future.
It's the
number, right?
future, yes. Good question. Exactly what I want you to do. It's what I want you to think about. What do I know? The only things there are future values, present values, interest rates, number of periods, and annuities, right? That's all there'll ever be. There'll be an ordinary annuity where it comes at the beginning or end of the period, and an annuity due at the beginning, but that's all, okay? So, number of periods was 3. Interest rate, what did they say it's going to be? 7%. Can you solve the present value? It's the same as the last question, isn't it? What's the present value of that one? Plug it in.
I got 81630.
Yeah, me too. Okay, good deal. You're going to get a lot of points on the test and the final with this, huh? Okay. Figure out what you're doing. Read carefully. It only takes a second to calculate, right? Read carefully. You can go berserk on you. Because when you see your quizzes, you'll probably think, wow, I missed it. Right? I missed it. Okay. All right, then the next one. Last one. On January 1st, 2014, Rich Company acquired a truck that had a purchase price of $50,000. What do you think that is? It's its present value. What it's worth, right? Seller agreed to pay for it over a 3-year period. Oh, what's in? 3. It's going to pay interest of 10%. What's the interest rate? Okay, do I want to calculate a future value on this? No, they're buying it. And they're making payments. What's that going to be? Ordinary, it's the end of the period. That's the only table we have. So ordinary annuity payment. But if you're using your calculator, you got to tell it it's ordinary payment at the end of the period. Okay? Equal payments. Equal payments makes it an annuity, right? Interest rate doesn't change. Payment doesn't change. Equal every time, right? Okay. So what do? I set this up. Ordinary annuity payment. You can plug in your calculator. Just calculate it, of course. Just know what you're doing before you do that. My ordinary annuity payment times the factor is going to give me this present value, right? At times 0. The factor is going to be what? Present value of an ordinary annuity, of course, because that's what we're calculating here. Oh, wait a minute, I'm not really calculating that. I calculated the payment, but it doesn't matter. I know the present value is $50,000, and I know some payment's going to pay it off. Okay? Number of periods, 3. Interest rate, 10%. Now think about this. Is that payment going to be more or less than 1/3 of $50,000? It's going to be more because they're going to add interest. Is that factor going to be more or less than 3? Yeah. Less. Right? Make the payment more. Got it. That's it. This factor is what $3 is worth received at the end of each period, right? For 3 periods, discounted at 10%. Of course, it's worth less than 3. What's the factor if you look it up? 3 periods at 10%. What is that? 2 something, right? If I invest $2.49, I can take out $1 at the end of each period for 3 periods. I'll have taken out for $3, and I will have earned exactly 10% interest, which should, I guess, be 51 cents. Got it? So but I'm not getting $1 3 times. What am I going to get if I'm receiving these payments? Take the 2.4869 divided into 50, and how much do you get?
2002.
20080. Okay, if you use the table, 20080. If you use a calculator, 20105. Okay? Because I'm rounding up the table. Okay? So, did anybody use their calculator?
Oh, I did.
Did you get 2105?
Yes, I got 2106 with rounding.
Okay, with rounding. Okay, good. We're good. For 20, I'll take the 20080, by the way. Of course, that's fine. Easy? No, no. We did really good. Well, I guess you just did beat so everybody happy. Life couldn't be better. It'll get better. It'll be summer. You get a couple weeks off before you start summer school. Yeah, I want to know. I don't know why we don't make school year round.